what are we seeing in this country? Let's start here with premiums, et cetera, in both tech and the overall markets that might shed light on what we're seeing in the yield curve and what its eventual effect could be.
Yeah, good morning, Joe. So, what we're seeing, I think, is a disconnect because, from 2020 to 2021 to now, we've had the biggest volatility normalization on record in the history books. So we're actually down on a realized volatility basis to pre-pandemic levels. And that's the fastest time it's taken for our options market to normalize compared to other crises like the global financial crisis. And I think that probably doesn't make sense in the face of what we're seeing from the Fed and other things ahead. So, I think the options market has not been telegraphing that much fear, but that is going to change even as we start to enter earnings season.
While I have you here, you did have some interesting comments. One of the lead stories in the Journal today is suddenly China realizing, wow, we're not going to hit a lot of the numbers we were hoping for, cutting some key interest rates as Omicron, I guess, affects the overall economy. You saw some things in the option markets. I don't follow them very closely over in China, but tell us what the disconnect there was, Amy.
Yeah, I think the disconnect there, and I'm using FXI, which is the China ETF, as the proxy. I think volatility there is probably too low in options land. We always just think about events because events are what is going to drive uncertainty. There's two really big events coming up. There's the Lunar New Year on February 1st, and then the Beijing Olympics on February 4th. And, we know how transmissive Omicron is. We know it's already been detected in China. And we know even with, the very tight controls that they keep, it's really, really tough to stop this thing. And I think that's going to drive volatility far off the levels we're seeing, which is why I've been recommending hedges through FXI puts.
Kevin, is the 10-year on your radar screen? It's obviously dictating some of the action that we're seeing, I think, especially in tech stocks?
Yeah, Joe, there's a lot of ominous signs here to start the year. I mean, you and I were just talking about the 10-year a few weeks ago when it started off the year at 1.51. Here we are a few weeks later, and it's over 1.8. That's a huge jump. And I think the reality is that this is probably where we should have seen it trading for most of the fourth quarter. So the shock, the surprise to the system is always hard to accept. The Fed's told us that they're going to raise rates, and until we see it, it's hard for us to believe it as a stock market. And I agree with Amy. The VIX is low, and I think we're going to start to see it increase. It's not telegraphing necessarily the volatility that's ahead, but I'll be surprised if we don't see it increasing, just like we saw the 10-year yield increase.
How does that set things up? And I want to quickly hear about walk towards wealth. I'm inclined, but I get out of breath pretty easily these days. I'm inclined to run towards wealth, or at least a fast trot towards wealth. What's your point with walking? To take it easy and make it measured and do it gradually long term? Is that kind of what you're talking about?
Yeah, exactly, Joe. I mean, the free money trade is over. The momentum trade is over. We had a lot of fun with meme stocks, but real wealth is built over time. You invest in great companies with increasing earnings, growing dividends, you reinvest those dividends, you compound that over time, and it has created incredible wealth for generations. It's a strategy that works. And I think as we see a Fed tightening environment and this whole dynamic and landscape change, back to basics is how you make money. Doing it slowly is appropriate. Walking towards it is fine. I know so many wealthy investors, and I know so few successful and wealthy traders that I wanted to bring some of that back to reality.
Shepard Smith here. Thanks for watching CNBC on YouTube.